Learning how to avoid losses in your investment portfolio will ensure you earn excellent returns, build long term wealth, and become financially free. For those who don't learn these strategies that will reduce their chances of losing money, investing won't be very profitable and is comparable to gambling. These people will eventually decide investing isn't worth risking their money and they'd rather work until the day they die. No one likes losing money, but investing to earn enough profit that will allow you to retire does entail a fair amount of risk. By taking note of these 8 important strategies that famous and extremely rich investors employ, you'll remain profitable when others are losing their life savings. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Number 8. Diversify. Diversification means spreading your investments around, and doing this will provide 3 main benefits. First, your risk will be minimized because your exposure to any single asset is limited. Second, you're avoiding losses that could stem from one stock or part of the market. An example of this could be when a company has some undesirable news, resulting in a large decline in its price. Third, you're earning more steady, long-term gains by spreading your money across many stocks. Proper diversification doesn't mean you simply own a variety of stocks. This also means that you should own various sectors and not become too concentrated in any single area of the market, whether it be technology, energy, consumer cyclicals, and so on. A huge mistake employees often make with their 401ks is purchasing too much of their company's stock when it's offered to them at a discount. This could mean their company's stock makes up 25-50% or more of their portfolio over time, and this level of concentration poses a huge risk. What if something negative were to happen to that stock? Having this many eggs in one basket could easily derail a retirement. Number 7. Have realistic expectations. There's nothing wrong with hoping for the best from your investments, but you could be headed for trouble if your financial goals are based on unrealistic assumptions. Lots of high-quality stocks have generated market-beating returns, far outpacing what you would earn by just investing in the overall market. This certainly doesn't mean you should always expect the same kind of return. By taking a look at the stock market's historical returns, this could provide insight as to what you could expect. Between 1957 and 2021, the S&P 500 has averaged 10.5%. This means there were some years that were extremely profitable and others when the annual return was negative. In 2005, the S&P 500 returned just 3%, followed by 13% in 2006 and 3% in 2007. But in 2008, the market returned negative 38%. During extended periods when the market performs better than average, it's easy to get used to it and expect this every year going forward, but this is completely unrealistic and reckless. Number 6. Invest in what you know. A famous piece of advice is to invest in what you know and avoid what you don't. One of the easiest ways to make an avoidable mistake is to get involved in investments that are overly complex or just something you don't understand. Most of us have spent our careers working in 1 or 2 industries, meaning you probably have a reasonably strong grasp on how these markets function. On the other hand, the majority of publicly traded companies are in industries we know little to nothing about. This doesn't mean you can't invest elsewhere. These investments should just be approached with caution. Investing isn't just related to the stock market either. There are many other ways to invest, such as purchasing fine arts, private money lending, owning gold and other precious metals, renting real estate, or buying businesses. Which of the many investments that are available is best for you will depend on your knowledge. For example, an expert in fine arts would probably be better off sticking to that craft than picking individual stocks, because having a deep knowledge of what you're buying will reduce your chances of losing money. Number 5. Don't over-leverage. Taking advantage of that super low interest rate by borrowing against your stocks on margin can be tempting, but this could be the biggest financial mistake you could make. What if you refinance your home and invest that money in the stock market, providing the ability to earn much more than the interest it's costing? This seems like a great idea when the economy is booming and profits are seemingly never ending. The problem with using too much leverage is that those debt payments become difficult to make when your income is interrupted, or the value of your stocks drops by a large amount and you receive a margin call requiring you to sell your stocks at a huge discount. For most people, it's best to avoid margin entirely and only invest the money you currently have. This can also be applied to borrowing against your home or using any other type of loan. Using borrowed funds to invest can give a major boost to your returns, but it's important to remember that leverage amplifies negative returns too. Number 4. Invest in line with your risk tolerance. Risk tolerance is the level of risk an investor is willing to take. Risk can mean opportunity, excitement, or a shot at big gains, but risk is also about tolerating the potential for losses. It's the ability to withstand market swings and the inability to predict what's ahead. When determining your risk tolerance, it's important to understand your time horizon or when you plan to withdraw the money you've invested. Do you plan on using investments to pay for a family vacation, fund college tuition, or is it there for your retirement? If you're invested in volatile assets, it can be hard to be patient during short-term swings and years of loss. Determining the right amount of risk you want to take will help you strike the balance of earning worthwhile profits and ensuring the value of your money isn't eroded by inflation. Number 3. Don't chase gains. Just because a stock was up 15% yesterday doesn't mean it will happen again today. Many investors get excited when they see profits in one area of the market and they're tempted to chase the big winners hoping they'll gain more. This herd mentality generally involves buying in at a high price or selling at a low price after a sell-off. Instead of following the herd, try to focus on investments that are undervalued or are worth more than what they're currently priced at, ones that haven't been noticed or have been oversold. This strategy, known as value investing, is what Warren Buffett implements, and it basically entails avoiding extremely popular stocks and investing in companies that are overlooked to some degree. Sectors of the market and single stocks go up and down. They won't be bullish all the time, and they won't be bearish either. Number 2. Have money set aside. One of the last things you want to have to do is sell your investments due to a lack of savings. Adding insult to injury, if you're required to sell some of your investments during tough times, it's likely to be when the market is down, or it could mean tapping into your retirement accounts, resulting in a penalty and an unexpected tax burden. Having an adequate emergency fund will mean you can stay invested when you're faced with a surprise expense or a lapse in income, allowing you to hold your investments for the long term. Experts recommend having at least 3 to 6 months of expenses set aside for unforeseen circumstances. This seems like a lot when you have a steady job, the market is rising steadily, and inflation is slowly eating away at your savings, but you should acknowledge the fact that a bear market could strike at any time. Number 1. Don't sell in a panic. A market crash or even a small decline in your investments can cause a lot of fear and anxiety among people who check their portfolio regularly or become overly absorbed in scary news headlines. No one enjoys seeing their money vanish, and it will have you wondering if it will ever return. Investing in the stock market can be risky, and it comes with a lot of volatility. To navigate this successfully, you need to keep a long-term investor mindset by thinking many years ahead. Historically, the market has always recovered, meaning if you're properly diversified, you're going to be alright if you don't plan on selling, even when it doesn't seem so. By taking a look at history, you'll find that a bear market, or when prices drop 20% or more, occurs about every 3.5 years and lasts an average of 289 days. By keeping this in mind, you'll be less likely to react negatively to such an occurrence, and you'll have a better idea of what to expect going forward. Keeping your emotions in check will help you make rational decisions, regardless of market conditions. The biggest fear of any investor is losing money and seeing their personal contributions shrink up to nothing. After all, the reason people invest in the first place is to protect the value of their money and earn profits that will help them accomplish their goals. By considering the most common reasons for investment losses, you can use them to your advantage and learn how to avoid losses in your investment portfolio. This will help you sleep better at night and maximize your returns.